shares in IA Financial, the insurer and wealth manager, are hot with investors right now. It looks as though the market likes updated earnings guidance for the next few years. Let's get more from Bloomberg's Stephanie Hughes.
Hey, Andy. Yeah, that's right. So IA Financial got a share bump up by nearly 6% today, which was its biggest gain in nearly a week. And the gain from nearly a week ago was a sizable one that briefly brought the share price to an all-time high. And like you alluded to, the reason why IA is doing so well today is because the wealth management firm updated its earning guidance over the next few years, now expecting its core earnings per share to grow by about 10% or more in the medium-term annual average growth outlook there. So in an announcement just ahead of its Investor Day event that took place today, it also said that its core return on equity can grow by 17% or more in 2027. On top of that, they also said that the core dividend payout ratio, which is a measure comparing the amount of dividends expected to be paid out to investors compared against the total profit the company sees, that metric there could grow by a range of 25 to 35%. So a lot of things that investors like to see here. The Chief Financial Officer, Eric Jobin, acknowledged that this was an ambitious market guidance, but he expects that the company will be able to reach it, just given that the company is engaging in some prudent capital management. Earlier this month, like you mentioned, the company shares reached an all-time high briefly because of its core earnings beat in the fourth quarter due to the strong Canadian and wealth management segment. So at the time, analysts said that this was a really solid quarter, and it looks like this earnings guidance today is really building on that confidence that investors are really expressing with the share price today, Andy.
And then we got to take over in the gold mining industry, but it's one of these meh transactions where there's no premium.
Yeah, it was a bit of an underwhelming merger as far as the market's concerned. So Calibre Mining, that stock fell as much as 8%. That was the biggest drop since last November, and it comes on the heels of a merger. So what happened here is that Calibre, the metals exploration company, agreed to be taken over at a at-market deal by Equinox Gold for about $1.8 billion. And so it's an all-stock deal, and it's expected to give Equinox an added precious metals capacity capacity expansion in the U.S. and Nicaragua. The combined company is also expected to be Canada's second largest gold producer in Canada, so that's kind of an interesting detail there. But analysts are thinking that Calibre can probably do better here. TD Cowen said that they're expecting a mixed reaction out of Calibre since the implied price for the company is at $3 per share. So that's a 3% discount from the Friday close. And analysts added that because Calibre has been a recent outperformer and there's a lack of a premium here, they believe that there's a potential for a higher bid. Raymond James seems to agree. They mentioned that Newco could be a potential higher bidder here, Andy.
Yeah, it's interesting. One broker asking, did Calibre sell itself too cheap?
Well, it's an interesting kind of negotiation in what has been a very busy merger scene for the metal space.
Thank you very much, Stephanie Hughes of Bloomberg.